When you turn 63, the IRS and the Social Security Administration start watching your money in a way they never have before. And a single extra dollar of income that year could end up costing you thousands of dollars exactly 2 years later. You probably think that your Medicare premiums at age 65 will be the same standard rate that everyone else pays. But because of a hidden mechanism buried in the federal tax code, your financial decisions at age 63 will entirely dictate your healthcare costs in retirement. I'm going to show you exactly how this hidden tax trap works, the 4 specific financial moves that trigger it without you even realizing it, and the one legal form that can completely erase the penalty if you've already fallen into it. You have spent decades planning for retirement. You have managed your 401k, paid off your mortgage, and calculated your Social Security strategy. But almost no one warns you about the 2-year look-back rule. My goal today is to protect your retirement savings from unnecessary drains. Over the next few minutes, we are going deep into the mechanics of Medicare's income-related monthly adjustment amount, a system designed to charge higher earners significantly more for their healthcare. We will start by uncovering why age 63 is the absolute tripwire. Then, we will break down the exact income cliffs that can penalize you for simply selling a house or shifting your investments. Finally, I will reveal the absolute best defense strategy to legally appeal these charges if you get caught. Grab a pen, because what you are about to learn could save you thousands of dollars in your first years of retirement. Most people believe that the magical age for Medicare is 65. You reach 65, you sign up for Part B and Part D, and you pay your standard monthly premium. In 2026, the standard Medicare Part B premium is just over $200 a month. It sounds predictable. It sounds manageable. But here is the critical piece of the puzzle that catches almost every new retiree off guard. The federal government does not base your Medicare premiums on the money you are making at age 65. They base it on the income you reported on your tax return exactly 2 years prior. This is called the 2-year look-back period. If you are enrolling in Medicare at age 65, the government is pulling your tax return from when you were 63. That makes age 63 the most dangerous year in your retirement planning window. It is the first year that every dollar you earn, every investment you sell, and every withdrawal you make from a traditional retirement account permanently attaches itself to your future healthcare costs. You might be wondering why this 2-year delay exists. The explanation is purely bureaucratic. By the time you turn 65 and enroll in Medicare, the IRS only has your finalized tax data from 2 years earlier. If you turn 65 in 2026, the IRS and the Social Security Administration have completely processed your 2024 tax return. So your 2024 income, the year you were 63, becomes the undisputed baseline for what you will pay for Medicare Part B and Medicare Part D in 2026. This system is known as IRMAA, which stands for the Income-Related Monthly Adjustment Amount. It was created to force higher-income retirees to pay a larger share of the actual cost of the Medicare program. But what constitutes higher income might shock you, especially if you happen to experience a brief spike in income right before you retire. Let us be completely clear about how IRMAA functions. It is not a gradual tax. It is what we call a cliff penalty. In the standard American tax system, tax brackets are marginal. If you move into a higher tax bracket, you only pay the higher tax rate on the specific money that falls into that new bracket. That is a fair system. IRMAA does not care about fairness. IRMAA is a cliff. If your income goes even one single dollar over the limit, your Medicare premiums for the entire year increase for every single month. In 2026, the first IRMAA threshold for a married couple filing jointly is $218,000. If you and your spouse have a combined income of $218,000, you pay the standard base premium. But if your income is $218,001, just $1 over the line, both you and your spouse will be hit with an IRMAA surcharge for Part B and Part D. That single dollar could cost a married couple an additional $2,297 a year in unexpected premium hikes. $1 triggers a $2,000 penalty. That is why age 63 is so terrifying if you are not paying attention. To protect yourself, you need to understand exactly what the IRS is looking at. They do not just look at your salary or your wages. They use a very specific calculation called Modified Adjusted Gross Income, or MAGI. You will hear accountants and financial planners talk about MAGI all the time, but for Medicare purposes, MAGI has a very unique and unforgiving definition. To find your Medicare MAGI, the government takes your adjusted gross income from your tax return and adds back certain types of income that are normally tax exempt. The most common and most dangerous addition is tax-exempt municipal bond interest. You might have spent your entire life investing in municipal bonds specifically because the interest is free from federal income tax. But when you turn 63, the government takes all of that tax-free interest and piles it right back on top of your income to see if you cross the IRMAA threshold. It is a stealth calculation. You pay no income tax on the bond, but you suddenly pay thousands more for Medicare because of it. Think about how easily this sneaks up on people. You might be a dual-income household. Maybe you are both making $90,000 a year at age 63. Your combined income is $180,000. You are comfortably below the $218,000 threshold. But then, you decide to sell some stock to pay off the remaining balance on your mortgage before you retire. You recognize $40,000 in capital gains. You also have a couple of municipal bonds paying out $5,000 in interest. Suddenly, your income is $225,000. You just crossed the cliff. 2 years later, when you are 65, completely retired, and living on a fixed income, you get a letter from the Social Security Administration telling you that your Medicare premiums are going to be double what you expected. And you have to pay it out of your fixed retirement budget, all because of a perfectly normal financial move you made 2 years earlier. This brings us to the 4 massive landmines that detonate during your 63rd year. If you can avoid stepping on these, you can save your retirement budget. The first landmine is the sale of real estate, specifically your primary residence or a vacation home. Downsizing is the classic American retirement dream. You hit your early 60s, the kids are gone, the house is too big, and you decide to sell the property and move into a condo or a warmer climate. If you sell your primary home, the IRS allows you to exclude up to $250,000 of profit if you are single, or $500,000 if you are married. That sounds generous. But the housing market has exploded over the last few decades. If you have lived in a home for 30 years, your profit could easily exceed that $500,000 exclusion. Any profit above that exclusion is added directly to your modified adjusted gross income. If you sell that house when you are 63, the massive capital gain drops right onto your tax return. It pushes you through not just 1, but potentially 2, 3, or even 4 IRMAA brackets. At the highest brackets in 2026, the IRMAA surcharge can cost a couple over $13,000 a year in additional premiums. That is over $1,000 a month disappearing from your checking account simply because you picked the wrong year to sell your house. If you had sold the house at age 62, it would have been completely invisible to the Medicare lookback. Timing is everything. The second landmine is the Roth conversion. We love Roth conversions. The idea of moving money out of a tax-deferred traditional IRA and into a tax-free Roth IRA is one of the most powerful wealth-building strategies in existence. But doing a Roth conversion at age 63 is playing with fire. When you convert money to a Roth, the entire amount you convert is treated as ordinary taxable income in the year you do it. Imagine you are 63, you are still working, and your financial advisor suggests you convert $50,000 to a Roth IRA because the market is down and it is a good time to convert. That $50,000 is added to your MAGA. If that pushes you over the cliff, your Medicare premiums skyrocket at age 65. You are essentially paying a hidden tax on the conversion. Does this mean you should never do a Roth conversion at 63? Not necessarily. Sometimes the long-term tax-free growth of the Roth outweighs the temporary 1-year Medicare penalty. But you must run the math. You cannot walk into a Roth conversion blindly. You have to treat the IRMAA surcharge as a direct cost of the conversion. The third landmine is severance packages and vacation payouts. When you transition into retirement, you rarely just stop getting paid on a Friday, and that is the end of it. Many professionals receive a severance package, an early retirement buyout, or a massive lump sum payout for unused vacation and sick days. If you retire at age 63 or 64, that final payout can be incredibly large. It feels like a beautiful parting gift from your employer. But because it arrives as a lump sum, it radically inflates your income for that specific year. The IRS views it as regular wages. The Social Security Administration sees it as proof that you are a high earner. So when you turn 65, even though you have been happily retired for a year or two and your current income has plummeted, you are hit with a maximum IRMAA penalty based on a severance package that you probably already spent. The fourth landmine is mutual fund capital gains distributions. This one is particularly cruel because it is entirely out of your control. You might be holding a standard mutual fund in a taxable brokerage account. You are not actively trading. You are not selling anything. But inside that mutual fund, the portfolio manager is buying and selling stocks. At the end of the year, by law, the mutual fund must pass the capital gains from those internal sales on to you, the shareholder. You receive a 1099 form showing a large capital gain distribution, and it goes straight onto your tax return. In a year where the market is booming, these distributions can be massive. If this happens to you at age 63, your MAGI spikes through no fault of your own. You didn't even see the cash. It was probably automatically reinvested, but you still pay the Medicare penalty 2 years later. Have you noticed the pattern here? Every single one of these landmines is a perfectly normal, legally sound financial event. No one is doing anything wrong. No one is hiding money. You are just living your life, managing your assets, and trying to secure your retirement. But because you are crossing the invisible tripwire of age 63, you are being severely penalized. The system assumes that because you had a lot of money on paper that 1 year, you can afford to pay the absolute maximum for your health care. If you are watching this and realizing that you might already be caught in this trap, do not panic. Stay with me, because in just a moment, I am going to share the exact loophole the government provides to completely erase this penalty if you qualify. It is a specific form that most people do not even know exists, and it is the ultimate get-out-of-jail-free card for new retirees. But before we get to the solution, we need to understand the true depth of the brackets so you can accurately predict your exposure. In 2026, the system is broken down into 6 distinct tiers. The baseline tier, where you pay no extra surcharge, is for single filers earning $109,000 or less and married couples earning $218,000 or less. That is Tier 1. Tier 2 kicks in the exact moment you exceed those numbers, jumping your Part B premium up to roughly $284, plus an extra surcharge on your Part D prescription drug plan. Tier 3 triggers at $137,000 for singles or $274,000 for couples, pushing your Part B premium over $400 a month. Tier 4 starts at $171,000 for singles and $342,000 for couples. Tier 5, a massive bracket, starts at $205,000 for singles and $410,000 for couples, rocketing your monthly premium past $640 per person. And finally, the maximum penalty, Tier 6, applies to anyone earning over $500,000 single or $750,000 married. At that level, your Part B premium approaches $700 a month per person, plus nearly $100 extra for Part D. When you look at these numbers, you realize that Medicare is not really a unified national health program. It is a highly variable expense that functions as a shadow tax on successful savers. The government justifies this by pointing out that the standard premium only covers about 25% of the actual cost of the Part B program. The taxpayers subsidize the rest. IRMAA is simply a mechanism to force higher earners to cover up to 85% of their own costs. The logic makes sense from a federal budget perspective, but it feels like a targeted punishment to the person paying the bill. It feels like you are being fined for saving diligently. So how do we fight back? How do we neutralize the threat of the 2-year look back? The first and most critical strategy is aggressive income management during the look back years. If you know you are turning 63 next year, you need to sit down right now and project your income. If you are sitting slightly below an IRMAA cliff, you must freeze any discretionary income generation. Delay that mutual fund sale. Postpone the Roth conversion until you are safely enrolled in Medicare, or do it before December 31st of the year you turn 62. If you want to sell a highly appreciated asset, consider spreading the sale out over multiple years using an installment sale, so you only recognize a small portion of the capital gain each year. This keeps you safely under the cliff. Another incredibly powerful tool to lower your MAGI is tax loss harvesting. If you have taxable investments that have lost value, you can sell them to realize the loss. You can then use those losses to offset capital gains dollar for dollar. Furthermore, you can use up to $3,000 of those losses to offset your ordinary income. If you are sitting $2,000 over an IRMAA cliff, simply selling an underperforming stock to harvest a $3,000 loss will pull you backward off the cliff and save you thousands in Medicare premiums. It is an immediate return on investment. You should also look closely at qualified charitable distributions known as QCDs. When you reach age 70 and a half, the government allows you to transfer money directly from your traditional IRA to a qualified charity. This money never touches your tax return. It completely bypasses your adjusted gross income, and therefore it completely bypasses the Medicare MAGI calculation. If you are forced to take required minimum distributions that are pushing you over an IRMAA cliff, and you already give to charity, using a QCD is a brilliant way to satisfy your charitable goals while simultaneously hiding that income from the Medicare calculation. But what if it is too late? What if you are 65 right now, you just got the letter from the Social Security Administration, and they are demanding an exorbitant premium based on a massive payout you received at age 63? What if you retired at 64, your income dropped to almost nothing, but Medicare is still judging you based on your final working year at 63? This is the absolute best part of the video. Listen to me very carefully. You do not have to accept the penalty. The government knows the 2-year look-back system is flawed. They know that a person's financial situation at 65 is often drastically different than it was at 63. To account for this, they created an appeal process based on what they call a life-changing event. If you have experienced a life-changing event that significantly reduced your income, you can file a specific document known as Form SSA-44 with the Social Security Administration. This form is your lifeline. It legally forces the government to throw out your age 63 tax return and calculate your Medicare premiums based on an estimate of your current year's income. You are essentially telling the government, I know what I made 2 years ago, but I don't make that anymore, and here is why. However, you cannot just file this form because you don't want to pay the higher premium. You must officially qualify under one of the specific life-changing events recognized by the SSA. The most common event, and the one that applies to almost every new retiree, is work stoppage or work reduction. If you retired, that is a life-changing event. If you transitioned to part-time consulting, that is a work reduction. If your spouse stopped working, that counts. The moment you retire, the massive salary you earned at 63 becomes irrelevant. You simply fill out the SSA-44, check the box for work stoppage, provide a copy of a letter from your former employer stating your retirement date, and provide an estimate of your new, much lower retirement income. The Social Security Administration will process the form and lower your premium immediately. Other qualifying life-changing events include the death of a spouse, marriage, divorce, or the loss of income-producing property due to a disaster or other event beyond your control. You can also appeal if you lost a pension, but be extremely careful here. The Social Security Administration is completely unforgiving about what does not count as a life-changing event. Selling a house is not a life-changing event. Doing a Roth conversion is not a life-changing event. Realizing massive capital gains in the stock market is not a life-changing event. If you triggered IRMAA because of a voluntary financial decision, you cannot appeal it. You have to pay the penalty for that year. The appeal process is strictly reserved for life circumstances that permanently alter your baseline earning capacity. The process of filing the SSA-44 is relatively straightforward, but timing is critical. When you receive your initial IRMAA determination letter from the Social Security Administration, you generally have 60 days to request a reconsideration. Do not ignore the letter. Do not assume you can fix it later. Download Form SSA-44, gather your documentation, and submit it immediately. If you miss the window, you will be forced to pay the higher premiums for the entire calendar year, and you will have to wait for the system to automatically reset the following year when they process your next tax return. Think about the profound impact of this knowledge. Millions of Americans enter retirement completely blind to the fact that their healthcare costs are being manipulated by decisions they made 2 years prior. They sell their family home to fund their retirement dreams, only to find themselves penalized by the very system designed to protect them. They follow generic financial advice to convert their IRAs, completely unaware that the conversion comes with a hidden thousands of dollars price tag attached to their Medicare card. They retire from their lifelong careers, receive a hard-earned severance package, and are punished for it at the exact moment they need their cash flow the most. You now possess the insight to see the trap before it springs. You understand that the year you turn 63 is the most sensitive, volatile year of your financial life. Every decision must be weighed not just against the standard income tax brackets, but against the hidden cliffs of the Medicare premium adjustment. You know that one single dollar of excess income can trigger a cascade of costs. You know that municipal bonds are not truly tax-free when the Social Security Administration is doing the math. You know to delay the home sale, or space out the capital gains, or utilize tax loss harvesting to actively manage your modified adjusted gross income down to the penny. And most importantly, you know that if the system unfairly judges you based on a salary you no longer earn, you hold the power to strike back using Form S SA-44 to demand a fair assessment based on your actual reality today. To recap the most vital points of our discussion, the IRS imposes a strict 2-year look-back period to determine your Medicare Part B and Part D premiums, meaning your income at age 63 directly controls your costs at age 65. The premium increases, known as IRMAA, operate on a cliff system, where crossing a threshold by a single dollar triggers the full penalty for the entire year. Standard financial moves like selling a home, receiving a severance package, or doing a Roth conversion at age 63 are the primary traps that cause massive premium spikes. And finally, if your high-income year was caused by wages from a job you have since retired from, you have the absolute right to file Form SSA-44, declare a work stoppage, and force the government to lower your premiums to reflect your current reality. Navigating the transition into retirement is difficult enough without falling victim to hidden bureaucratic penalties. Your financial security depends on foresight, strategy, and understanding the rules of a game that most people don't even know they are playing. I want to know how this hidden look-back period is impacting your retirement timeline. Have you already fallen into the IRMAA trap, or are you actively planning to avoid it as you approach 63? Go down to the comments right now and tell me your experience with Medicare premiums, because your story could be the exact warning someone else needs to hear today. Keep protecting your wealth, and I will see you in the next one.